Most people who try trading lose. Not because the market is rigged, not because they don't have the right broker or the right software. They lose because of what's happening between their ears. The 1% of traders, the ones making consistent, life-changing money, they're not necessarily smarter than you. They didn't go to better schools. They didn't start with more capital. What separates them is their mindset. I'm going to take you inside the psychology of elite traders, the habits, the belief systems, the non-negotiable mental frameworks that allow the top 1% to profit while everyone else bleeds. This isn't a lecture on technical analysis. This isn't about indicators or entry signals. This is about the inner game of trading. And if you get this right, everything else gets easier. Let me start by destroying a myth. The 1% trader is not who Hollywood tells you they are. They're not the guy screaming on the trading floor, high on adrenaline, making reckless bets, and getting lucky. That character exists, but they flame out fast. The real 1% trader is almost boring. They are methodical, they are disciplined, they treat trading not like gambling, but like running a high-performance business. The market rewards discipline over brilliance every single time. Think about it this way. If you asked 100 people to describe their ideal trading session, most of them would say, big win, huge profit, fast money. Ask a 1% trader the same question, they'll say, I followed my plan. I respected my risk. I stayed emotionally neutral. That's the first clue. The 1% trader has fundamentally different definitions of success. They don't measure themselves by the size of one trade. They measure themselves by the consistency of their process. You want to know something striking? Many of the world's best traders have losing days, plenty of them. What makes them elite is their ability to ensure that their wins dwarf their losses over time. That requires a completely different way of thinking, and that's what we're going to unpack today. Here's where most retail traders go completely wrong. They think about trading in terms of outcomes. Will this trade win? Will it lose? They're obsessed with being right. The 1% trader doesn't think in outcomes. They think in probabilities. Let me show you what I mean. A novice trader places a trade. It loses. Their reaction? I was wrong. My strategy is broken. I need to find a new approach. A 1% trader places the same trade. It loses. Their reaction? That was within the expected distribution of outcomes for this setup. I move to the next trade. Any single trade is essentially meaningless. The edge plays out over hundreds of trades. This is the concept of thinking in samples, not single events. Imagine a coin flip game where you win $2 for every heads and lose $1 for every tails. It's a profitable game in the long run, but in a single flip or even 10 flips, you might lose. Does that mean the game is rigged? No. It means you haven't let the edge play out. Trading is identical. If your strategy has a 55% win rate with a 2-to-1 reward to risk ratio, you have a significant statistical edge. But over 10 trades, you might go 3 for 10. Over 100 trades, the numbers will normalize. Most traders quit or change their strategy after a losing streak that is completely statistically normal. They're abandoning the coin flip game in the middle of a bad run. The 1% trader knows their numbers cold: win rate, average winner, average loser, maximum drawdown expected. They've backtested and forward tested to the point where they have statistical confidence. And because they know their numbers, a losing streak doesn't panic them. It's just the normal variance of a profitable system. Action step. Before you trade any strategy live, you must know your edge. Run it through at minimum 100 historical setups. Know your expected win rate. Know your average risk reward. Trust the numbers. I want to talk about the two emotions that are silently destroying most traders' accounts: fear and greed. Not because those are new ideas, you've heard this before. But I want to help you understand exactly how they show up in real trading, because they're sneakier than most people think. How fear shows up. Fear doesn't always look like hesitation. Sometimes it looks like overtrading. You take a loss, fear of more losses makes you jump into the next trade immediately to make it back. That's fear disguised as aggression. Fear also shows up as cutting winners short. Your trade is up 2R, double your risk, and you close it because you're terrified of giving the profit back. So you consistently take small winners while letting losers run. Your win rate looks great, but your account is draining. Fear makes you a slave to your P and L. The 1% trader is the master of it. How greed shows up. Greed is the feeling that you could have made more. So you move your stop loss further away, you size up way beyond your plan, you ignore the exit signal because it might go further. One greedy decision can wipe out a week or a month of carefully built gains. The 1% trader has learned this lesson, usually the hard way, and has systems in place to prevent greed from operating. The 1% trader's emotional protocol. Elite traders don't eliminate emotions. That's impossible. What they do is build a system that makes emotional decisions unnecessary. Before they enter a trade, they know exactly where they're getting in, exactly where their stop loss is, and exactly where they'll take profit. These are not negotiable during the trade. The decisions are made when the market is closed and they're thinking clearly, not in the heat of a live trade when cortisol is flooding their system. Here's a powerful technique, the pre-trade ritual. Before placing any trade, the 1% trader asks themselves 3 questions. 1. Is this setup exactly in line with my strategy? Not kind of. Exactly. 2. Have I predefined my risk? Do I know the worst case scenario? 3. Am I placing this trade from a place of calm logic, or am I reacting to something? If the answer to any of those is wrong, they don't trade. Simple as that. The journaling habit. Virtually every elite trader journals, not just the trades, the emotions. Before the trade, what are you feeling? After the trade, what emotions came up? After a loss, how did you respond? Over time, a journal becomes a mirror. You start to see your patterns. You catch yourself before you make emotionally driven decisions. You build self-awareness that the average trader never develops. The 1% trader knows themselves better than they know any market, because ultimately, your biggest enemy is not the market, it's yourself. If there's one pillar that separates the 1% from everyone else more than any other, it's this: risk management. Most traders think about profit first and risk second. The 1% trader thinks about risk first, profit second. Always. Amateurs focus on how much they can make. Professionals focus on how much they can afford to lose. Let me give you the core framework. The 1% rule: never risk more than 1 to 2% of your total account on any single trade. That's it. That's the rule. This sounds conservative, and it is, intentionally. Here's why it matters. If you're risking 1% per trade, you'd have to lose 50 trades in a row to blow out your account. That is statistically nearly impossible if you have any kind of edge. You'd quit trading before the math got there. But if you're risking 20% per trade, which is not uncommon among gamblers, masquerading as traders 5 losing trades in a row ends you, and 5 losing trades in a row happens to everyone, position sizing is a skill. Most traders pick their position size based on how confident they feel about a trade. High confidence, big size. Low confidence, small size. The problem is that confidence has almost no correlation with outcome in trading. You can be completely confident in a trade that fails and completely uncertain about one that succeeds. The 1% trader sizes positions based purely on math. Where's my stop? How many pips or points to the stop? What is the dollar value of that risk? Size the position so that dollar risk equals my predetermined 1 minus 2% of account. Emotion removed. Math in control. The asymmetry principle. Elite traders only take trades where the potential reward is at least twice the risk, preferably 3 times. This is called the risk-reward ratio. When you combine a 55% win rate with a 2-to-1 risk-reward ratio, the math becomes extraordinary. Even if you drop to a 45% win rate, you're still highly profitable. This gives you a huge margin for error. You don't have to be right most of the time. You just have to protect your downside and let your winners breathe. Knowing when not to trade. The 1% trader understands that sometimes the best trade is no trade. Before major economic news events, when volatility is unpredictable, when the setup isn't perfectly aligned with their strategy, when they're emotionally compromised, tired, stressed, or angry, most traders feel they need to be in the market constantly. The 1% trader is selective. They wait. They let the market come to them, and when the setup is right, they strike with conviction. This next pillar is one most traders avoid talking about because it's uncomfortable. Accountability? When a trade goes wrong, what's your first instinct? Be honest with yourself. Most traders blame. The market was manipulated. The broker hunted their stop. The news was unexpected. A whale moved the market against them. And here's the thing, some of those things might occasionally be true, but the 1% trader doesn't operate from that framework, because blame is a dead end. If it's the market's fault, you can't fix it. If it's your fault, you can. Radical accountability means looking at every single loss and asking, what could I have done differently? What did my system say? And did I follow it? Was the entry valid by my own rules? Sometimes the answer is, I followed my plan perfectly and lost. That's fine, that's just variance, no improvement needed. But other times, the honest answer is, I deviated from my plan. I moved my stop. I sized up too large. I traded out of boredom. I ignored my own signal. Those losses, the ones where you broke your own rules, are the ones you must own completely, because they are 100% within your control. The after-action review. Military special operations units debrief after every single mission. What went according to plan? What didn't? What would we change? The 1% trader applies the same discipline to trading. After every trading session, they review every trade. Not to beat themselves up, but to learn and optimize. Over time, this creates compounding improvement. Every mistake identified is a mistake that gets made less often. Every pattern recognized is an edge refined. Average traders repeat the same mistakes for years because they never stop to examine them. The 1% trader evolves rapidly because they make accountability a daily practice. Accountability with performance. The 1% trader also holds themselves accountable to their numbers, not to arbitrary income goals. They set goals around process metrics. Did I follow my risk rules? Did I stick to my watch list? Did I trade my system? If the answer is yes, across the board, they consider it a successful day, even if they lost money. Because they know that process consistency leads to outcome consistency. You cannot control whether any individual trade wins. You can control whether you execute your edge perfectly. I want to tell you something that the trading industry doesn't want you to know. Most traders who eventually become consistently profitable took years, not weeks, to get there. The overnight success story in trading is almost always a myth. Or worse, someone who got lucky, gave it all back, and disappeared. The 1% trader has made peace with the timeline. They're playing the long game. Consistency over years beats intensity over weeks every single time. What does playing the long game look like in practice? It means protecting your capital above all else. A trader who preserves their capital through a difficult period can always recover. A trader who blows up their account is done, at least until they can raise new capital. It means starting small and scaling only as your skill and consistency improves. Not starting with your maximum possible position size because you're impatient. It means treating your first year of trading as tuition. You're going to pay the market for an education. The question is whether you pay $5,000 in tuition or $50,000. The 1% mindset keeps the tuition cost low by trading small while learning. Building a trading career versus getting rich quick. There is a version of trading that is a get-rich-quick scheme. Most retail traders are playing that version. They deposit $1,000, use 100 to 1 leverage, and try to turn it into $100,000 in 3 months. And they fail over and over again because that's not trading, it's gambling with extra steps. The 1% trader thinks like a business owner. They build systems, they track performance data, they reinvest profits, they compound slowly and consistently. A 5% monthly return, which sounds unimpressive, is 60% annually. Compounded over 5 years, that's wealth building performance. The trader playing the long game will eventually outperform every trader who's chasing fast money. Because while the fast money trader is blowing up accounts and starting over, the long game trader is compounding. Patience is not passive. In trading, patience is one of the most aggressive competitive advantages you can have. The 1% trader is never finished learning. That's not a cliche, it's a competitive reality. Markets evolve, conditions change. Strategies that worked in a trending market fail in a ranging market. Liquidity dynamics shift. New instruments emerge. The trader who says, "I've figured it out," is the most dangerous kind, because the market will eventually shift and expose their complacency. Your greatest edge is not your strategy. It's your commitment to getting better every single day. What continuous mastery looks like: daily chart study, not looking for trades, but studying price action. Understanding why the market moved the way it did yesterday. Building a deep intuition for market structure over time. Regular backtesting and strategy review. Markets evolve, and so must your approach. Every quarter, review the performance of your strategy. Is the edge still intact? Are there patterns you're missing? Learning from other elite traders. Not copying their setups, but studying their philosophy. How do they think about risk? How do they manage their psychology? What books are they reading? The 1% trader has a reading list that never ends. They study behavioral economics, market history, trading psychology, and risk management. They understand that trading is a multidisciplinary skill, and they invest in every dimension of it. The beginner's mind. One of the most counterintuitive traits of elite traders is their willingness to say, "I don't know." Less experienced traders feel pressure to have all the answers, to predict every move, to appear confident about every trade. That false confidence leads to overtrading and oversizing. The 1% trader operates with what Zen Buddhism calls beginner's mind. They stay humble about the market's unpredictability. They never assume they know what will happen next. They only act when their defined edge is present, and they let probability do its work. We've covered a lot of ground today. Let me bring it together for you. The 1% trader thinks in probabilities, not predictions. They know their edge statistically and trust it across a large sample of trades. They master their emotions not by eliminating them, but by making the critical decisions before emotions can interfere. They are obsessed with risk management. They define their risk before every trade and never deviate. They hold themselves radically accountable. Every mistake is a lesson. Every deviation from the plan is examined and corrected. They play the long game. They compound slowly and consistently. They build a trading career instead of chasing a single jackpot. And they commit to continuous mastery. They never stop learning. They stay humble. They stay hungry. The market will always be here. The question is whether you build yourself into the kind of trader who deserves to profit from it. You do not rise to the level of your goals in trading. You fall to the level of your systems and your self-mastery. Start there, build there, and the results will follow. If this hit home for you, share it with the trader who needs to hear it. Subscribe for more content on trading psychology, strategy, and building a sustainable trading business. I'll see you in the next one. Trade smart, trade with discipline. See you on the other side.